90% of traders lose money not because their math is wrong, but because their biology is broken. Your brain is wired to survive in the wild, which makes it a terrible tool for navigating financial markets. Today, the US stock market is completely dark, taking a mandatory pause for the observed July 4th bank holiday. While the major tickers are frozen, it gives us the perfect opportunity to step back from the screens and dissect the invisible force that actually dictates whether you make money or get wiped out. The biggest lie beginners believe is that successful trading requires a secret indicator or a massive crystal ball. It does not. The charts you look at are not visualizations of asset values, they are real-time maps of human emotion. What most people do not know is that your brain processes a financial loss in the exact same region where it registers intense physical pain. When a stock dives, your amygdala screams at you to flee, forcing you to panic sell at the absolute bottom just to make the emotional agony stop. On the flip side, watching a coin or a tech stock shoot up releases a rush of dopamine similar to winning a casino jackpot. This triggers intense greed, causing you to chase the high and buy right at the peak. If you can't control these biological impulses, any strategy you use is completely useless. Before you skip ahead to the strategies, we need to address the hidden psychological traps that your own mind lays for you every single day. The most dangerous one is loss aversion, a concept proven by psychologists that shows human beings feel the pain of a loss twice as badly as the joy of an equal gain. In the markets, this creates a fatal flaw where traders hold on to losing positions for months, praying to break even, while cutting their winning trades after 5 minutes just to secure a small ego boost. You also have to fight confirmation bias, where the moment you buy a stock, your brain actively ignores bad news and only looks for headlines that agree with your position. The surprising part comes next because even if you master these individual biases, you still have to survive the emotional roller coaster of the broader market cycle. Think about how you felt during your last big trade. When the market is rising, you experience optimism, which quickly morphs into thrill and overconfidence. At the absolute peak of the market, euphoria sets in, making you feel completely invincible. This is exactly where amateur traders double their position sizes and ignore all warning signs. Then the tide turns, and as the market drops, you slide into anxiety and denial, telling yourself it is just a temporary pullback. By the time the market hits the absolute bottom, denial turns into pure capitulation and panic, forcing you to dump everything at a massive loss. The professional trader is the one standing on the other side of that panic, calmly buying your assets for pennies on the dollar because they have decoupled their emotions from their capital. If you want to survive long enough to build real wealth, you have to transition from emotional guessing to mechanical risk management. This starts with the strict implementation of the 1% rule. Professional traders rarely risk more than 1 to 2% of their total account value on a single trade. Notice that risk is not the same thing as position size. If you have a $10,000 account, risking 1% means you are only allowed to lose $100 if the trade goes completely wrong. You calculate your position size based on where your structural stop loss sits, ensuring an automated order cuts your trade the moment the thesis fails. This removes the need to make a stressful, emotional decision when a position is actively moving against you. The mathematical engine that drives professional profitability is the risk-to-reward ratio, and understanding this will change your trading forever. If you are enjoying this deep dive into market psychology, make sure to hit the subscribe button right now so you do not miss our daily breakdowns when the markets reopen on Monday. By maintaining a strict risk-to-reward ratio of 1 to 3, you risk $100 to make $300. This completely flips the math of trading in your favor, meaning you can be completely wrong 70% of the time and still walk away with a net profit at the end of the month. Amateurs focus entirely on their win rate, while professionals focus entirely on their mathematical expectancy. You must understand the brutal asymmetry of capital recovery before you ever place another order. Losing money is a linear process, but recovering that money requires exponential growth. If you lose 10% of your account, you need an 11% gain just to get back to where you started. But if you let a bad trade run and lose 50% of your account, you now have to double your remaining money, requiring a massive 100% gain just to break even. This is why professionals have an unyielding uncle point, which is a daily or monthly drawdown limit that acts as a total circuit breaker. If they lose 5% of their capital in a given month, they shut down their laptops, walk away from the desk, and do not place another trade until the next calendar month begins. Now that you understand the rules of psychological survival, we can look at how the greatest investors in history used these exact principles to generate legendary fortunes. Let us start with the ultimate master of emotional discipline, Warren Buffett, who built a net worth exceeding $140 billion. Buffett is famously known for value investing and his unparalleled emotional stoicism, operating on the rule to be fearful when others are greedy and greedy when others are fearful. While the crowd is panicking during market crashes, Buffett utilizes his massive cash reserves to buy high-quality companies at steep discounts. His compounding machine, Berkshire Hathaway, has delivered an astonishing 20% average annual return for decades, proving that patience and emotional control outperform high-frequency trading every single time. If Buffett is the king of patience, Jim Simons was the absolute master of removing human emotion entirely from the equation. Simons was a legendary mathematician who founded Renaissance Technologies and pioneered the field of quantitative trading. What most people do not know is that his flagship medallion fund generated the greatest track record in financial history, achieving average annual returns of roughly 66% over a 30-year span. Simons openly admitted that human beings are too emotional to trade effectively, so he built complex algorithms to exploit tiny, repeating patterns in market data. He did not care about the news, the economy, or his gut feelings. He simply trusted the cold, hard math of his system, creating a $25 billion fortune in the process. For those who want to understand macro trading, look no further than George Soros, the man who became famous for breaking the Bank of England in 1992. Soros is known for his immense risk tolerance and his theory of reflexivity, which states that investor biases actually change market fundamentals. His quantum fund generated spectacular returns averaging over 30% annually for decades. During his famous short position against the British pound, Soros risked billions of dollars on a single macroeconomic thesis, walking away with a historic $1 billion profit in a single day. Soros succeeded because he possessed the unique psychological ability to tolerate extreme volatility without blinking, cutting his losses instantly when he was wrong and doubling down aggressively when he was right. Then we have Peter Lynch, who managed the Fidelity Magellan Fund from 1977 to 1990 and achieved an incredible 29% average annual return. Lynch effectively doubled the return of the S&P 500 during his tenure, taking the fund from $20 million to $14 billion in assets. He was known for his invest in what you know philosophy, encouraging average people to find incredible investments by looking at everyday consumer trends before Wall Street noticed them. Lynch succeeded because he maintained absolute discipline, refusing to get shaken out of his favorite stocks during market corrections, famously stating that the key organ for investing is the stomach, not the brain. The common thread connecting every single one of these market legends is not their access to superior data, but their flawless psychological control. They mastered the rules of risk management, accepted losses as a standard cost of doing business, and never let fear or greed dictate their execution. If you want to see exactly how these psychological rules play out when the real capital starts moving again, you need to watch our next video, where we will break down the immediate price action and major gaps that occurred across the markets today. For now, click on the video appearing on your screen to master your technical analysis, and we will see you on Monday morning when the opening bell rings.